Ashwini Agarwal is with us, founder and partner at Demeter Advisors. Ashwini, good to have you with us here. Good morning. Do you think it's these GST cuts, bulk of things moving to 5 from 18 to 12, it'll provide that much needed durable lift to consumption, Ashwini? And which segments do you think are likely to benefit the most, in your opinion? The mass level, or still it's going to be the premium end?
So, Prashant, just last week somebody was asking me, I don't know who it was, I can't recall, as to what would you wish for in terms of, reforms. And I was saying that, it's about time that the GST system is simplified. Number of slabs brought down to 2, which was promised at the time of the rollout of GST. And to my mind, this is a very welcome move. So I think all categories will be impacted, more so on the staple side, where the consumer is a little more price sensitive, and low-end autos as compared to the premium side, because the premium demand is not really that price sensitive. Having said this, I think the biggest benefit from this is going to be fewer controversies, fewer disputes with the department, in terms of what tax is owed to the government. Hopefully, the simplification of the slabs will remove, that ridiculous example of popcorn, whether it is salted or caramelized or buttered, being charged at different GST rates. So I think that simplification adds to the ease of doing business, and that to me is a very, very big positive, in addition to probably stoking demand at the lower end of the price curve.
Ashwini, hi, morning.
Morning.
Yeah, indeed, that was quite the GST meeting. Infamous for the caramel versus salted popcorn, right?
That's right.
But this is far more meaningful, what we're hearing, what we're understanding right now. So from a market perspective, how do you play it? Do you go into staple stocks? Do you look at buying beaten down four-wheeler names? No one's been buying stocks like Maruti and Hyundai for a while, right? So how do you as an investor navigate for this new GST regime?
So, interesting question. I'm still trying to get my head around it. Autos has obviously been appreciated as a sector for a while. There have been no takers for it. And this might provide a rally for auto stocks in the near term. Medium term, we have to see if the demand revives. Now, zooming out, if I look at it, there are 3 or 4 factors at play. Number one is that liquidity and interest rates are far more benign now as compared to a year ago. Your inflation statistics are still telling us that there is no worry on the inflation front. You have a serious reform which promises to lift consumption. And hopefully, you have that additional 25% tariff on India going away at some point. Maybe not right away, maybe 3 months from now, 6 months from now, I can't say. Unless, of course, the US administration has singled India out for some punishment, which is possible. But I think, given how things are going, it's I would say that at some point in time, that additional 25% tariff is going to go away. So if you take all those 3 things into account and take the correction that's already behind us and look for a demand recovery 6 months down the line, that's overall positive for any consumption-driven stocks, whether it's auto, whether it's staples, whether it's domestic white goods, cyclicals, etc., etc. So I think overall the factors that are lining up for a more positive second half of this fiscal year are more than the headwinds, and that would appear to me to be the case as of now.
Hi, Ashwini.
Yeah, sorry.
Go ahead, please.
Yeah, and how am I looking to play it? I think, financials is still the best because, if demand picks up, then you should see an improvement in loan growth. You should see improvement in deposits growth, because deposits growth and loan growths are interlinked in a sense. And spreads are stable, funding is adequate, and hopefully no new loan losses will arise, and the stress on the microfinance sector will decline. So that may be an area that will continue to do well. At least that's what it appears to me. Yes, Nigel.
All right, Ashwini, hi, good to see you, Win. First, tell me, what's on your wish list again because it appears your wish list get ticked off. So that's good. And, within the financials, what do you like? Some of these large private sector banks that actually underperformed, case in point being an HDFC Bank, they actually outperformed in the last few months or so after underperforming for the last few years. What is your preference out there, private versus public banks, and also in the NBFCs, what do you like? Gold companies, suddenly, you had a blowout quarter coming in from Muthoot. Do you like that? Do you like the housing finance? What would be on your pecking list?
NBFCs as a starting point. I'm a value investor, remember, and so that tells me that NBFCs are undervalued at this point in time. Probably a lot of the stress is already priced in. If the second half promises to be better on credit costs, then I think in some cases you could see valuations move up from being at below book to maybe 1.2, 1.4 times price to book. That would still be a far cry from the 3+ time price to book that many of these NBFCs enjoyed as early as a year and a half ago. So that would be the first area of preference for me, especially the beaten down names. And the second would be, I would guess, the PSU banks, because, if you look through the results of the PSU banks, they've shown that they've proven to be nimble. I mean, the largest of them being the nimblest of them. And valuations are, again, very reasonable. If there is a broad-based growth, then I have no doubt in my mind that the PSUs will participate in that growth. And going back to a principle I always like, that when growth is abundant, valuations come into focus, and when growth is scarce, then quality growth come into focus. So if we build a case that growth is going to be reasonable pretty much across the board second half of this year with credit costs under check, then I think valuations be the focus, and that's why PSU banks over private sector would be my argument.
Got it. Ashwini, just a thought experiment. If
Yes.
these rates, auto rates come down, right? Do you think an entry-level car gets more of a boost or an SUV? Prices go down for both.
So it's a question of, where the consumer has moved to. The market globally has moved to SUVs. So it's not just India. Globally, SUVs is the preferred vehicle. And therefore, if the affordability on an EMI basis increases, it increases across the board. And that preference for SUVs is not going to decline. Having said this, there might be some first-time buyers who might find that accessing their first car becomes a little more affordable with lower rates and with GST cuts, and that might egg them on. We still have to see the GST cuts come through and when they become effective. So that's just a note of caution. I mean, we are all getting very excited, but there is still a lot of fine detail that's to become available.
I just hope there is no slip between the cup and the lip in that sense, right? That's always a thing. By the way, Maruti hit almost 14,000 rupees. It's come off about 250, 300 rupees from the highs. Actually, across the board, and that's to be expected. There is a little bit of a pullback, not very much. Still strong gains through and through.
Yeah, absolutely. By the way, one more category which is being widely discussed and debated is hotels where the average room rate is below 7,500 rupees. And there the hope and expectation is that the GST rate will move down to just 5%, as nominal as that. And that explains in parts why not so much Indian hotels, but a Lemon Tree, for instance, yes, that's the stock, 5% higher this morning. So, big moves coming in over there as well. Just very quickly, this space, Ashwini, anyway, hospitality has been doing so well, right? Decent gains, good wealth creation over the last 1-2 years. Do you like anything here? And would you play, again, some of the more mass category offerings out there, or largely on the luxury side of it?
I actually like, airline stocks here, because I think on a sustainable basis, I thought that, Air India would set the cat among the pigeons, be taken over by the Tatas, but that unfortunately, for a variety of reasons, hasn't happened. The market continues to exhibit significant pricing power. So that's one. And even in the hotels industry, while a lot of capacity is coming on, the capacity addition lags demand. And my sense is that these two will continue to benefit from the domestic demand and shift in consumption patterns that we've seen. Obviously, if the GST rate for hotels below 7,000 rupees go down to 5% and above 7,000 go to 40%, you would expect some consumers to shift. I mean, the price differences would become very stark. And I imagine that in some cases, some of the kind of premium properties might need to look at their rates to reduce the gap in pricing. So at the margin, I think yes, this is not so great news for premium 5-star properties, and stocks might take a bit of a knock. Again, Surabhi, I'm not prepared to pull the to make a call on this right away, because we don't know what the fine print will finally say on GST.
Okay, all right. Ashwini, we'll leave it there. Thank you very much for joining us. Good speaking with you, and thank you for taking out the time. Have a good week.